Let's get to the 5 investing mistakes and how to fix them. The first investing mistake is investing for retirement. Now, I may get a lot of bashing for saying this, but the reason why so many people reach retirement without appropriate savings cover is that they invest for retirement and lose interest midway. See, retirement is a very distant long term goal. For someone at 25, it's 35 years away. For someone at 35, it's 25 years away. People are more concerned about what they need a year from now or 6 months from now. Due to the tiny growth in the corpus at the beginning, you need tremendous discipline to forego the comforts of today to invest for a time that is decades away. After all, the compounding starts working only in the later parts of the journey. So anything meaningful will start appearing only after 15 to 20 years of investing. The solution then is that you should invest in near term goals. For example, my objective with my investment portfolio was to make as much money that could help me drop my job not in my 60s but in my 30s. And I put everything I could to make that work. I found high yielding strategies that delivered 90% plus returns per annum, put as much money as possible in my demat account, learned new skills to make more money on the side to top up my demat account, and put my wife's entire salary each month into her demat account. All of that put together helped me accumulate a multi-crop portfolio and left me with strategies that will help me grow this money at a fast clip for life. I gave myself 10 years to do all of that and I did it in 7. Not only that, the new skills still bring me money on the side, so I don't have to dip into my investment portfolio for my living expenses. So all of that happened with just one near-term goal: to be financially free as early as possible. I didn't even think of retirement while doing all of that. There is no fun in being an old millionaire in a wheelchair. You need the money when you can enjoy it, not to pay skyrocketing healthcare bills in old age. Therefore, it's a must for you to replace your retirement goal with a bigger, more substantive short term goal. This will drive you to do bigger things in life and transform your finances entirely. The second mistake I think is ruining your investing returns is not having a clear investment philosophy. An investment philosophy is a pillar on which your financial life stands. For your investment philosophy could be as simple as investing in growth companies or in mutual funds that invest in growth companies to clock 20 to 25% return per annum for the next 10 years, or it could be as simple as investing in established companies to get a stable 12 to 15% return per annum. It is essential to identify or form your philosophy. Write it on a piece of paper to come back to it every time your mind tries to deviate from it. Now, choosing an investment philosophy depends entirely on your life circumstances and your objectives with your money. So, for example, if you are 25 earning 50,000 rupees per month, saving 10,000 rupees in FDs for a safety is a disaster investment philosophy unless you're doing it to accumulate an emergency fund or setting aside money for near term needs. With that much time on your side, your investment philosophy must have investing vehicles and strategies that can compound your money much faster, say 25 to 30% or even higher, even when they come with a higher risk. When I was that age, I aspired to double my money every year, and I worked very hard to formulate an investing strategy that delivered those returns. New investors or young investors aged 20 to 35 have to understand that their investing philosophy can't be tilted too much towards capital preservation or safety. With that, you will miss out on high returns that come with a little bit of risk taking. A poor investment philosophy means that you will keep getting substandard returns on your investments, which will compound to a massive deficit a few years down the line. On the other hand, a cogent investment philosophy can help you achieve your desired aim much faster and set you up to achieve even bigger objectives like getting financially free or even getting into the top 1% riches of the country. Yes, that is possible through investing. The third mistake people make is not developing an edge. Now, this applies more to DIY investors who do the most of heavy lifting themselves. If you don't invest yourself already, I suggest you start doing it for one reason, and that is to put your sweat equity into your investments. Let me explain. When I invested in mutual funds for a brief period, I was not serious about it because I was not involved in managing that money. My efforts in growing that money were zero, and so was my motivation. No wonder I chickened out. But it is not only me. The data says 97% of the mutual fund investors end their investing journey in less than 10 years. Apparently, almost all of us chicken out. I realized early on that if I were involved in investing and growing my money, I would be much more inclined towards putting as much as possible in my investment account. However, that motivation will also come only when I have an investing edge that delivers meaningful returns. Returns that were high enough to scare me from pulling the money out of the account. For me, the trade off was to double my money every year or kill the goose for a shiny car, the latest iPhone, or a fancy home. I choose to work on that investing edge. I read hundreds of books, read thousands of blogs, and watched tons of videos to formulate a strategy that will help me double my money every year. When I started working on that investing edge in 2016, I had 60,000 in my investment account, the money that has now grown 1,000 times. It's not only me, even Warren Buffett started investing with just one edge, buying undervalued companies using Benjamin Graham's formula and holding them till the stocks reached their fair value. Buffett famously said he is constrained by size. If he had only $1 million to invest today, he would easily clock 50% per annum returns using the same edge. At 50% per annum, 1 lakh rupees grows to 58 lakh in 10 years, 10 lakhs grow to a whopping 5.8 crore in 10 years. Now, developing an edge can seem easier than ever. There is so much investing knowledge available for free. However, that is also a cause of information overload. It's quite likely that you'll get stuck in the web of information, be very knowledgeable, but still not be able to do anything good with your investments. Because to make money from markets, you need depth in the topic, not breadth. The internet only gives you breadth. So, what is the right way to develop an edge? You need to focus on depth. Practice the one kick 10,000 times rather than practice 5,000 kicks 2 times each. To do that, it is best to pick one guru like Warren Buffett picked Graham and I picked William O'Neill to formulate an investing system that generated life-changing returns. Pick that one system or strategy that suits your investment objective and learn everything there is to learn. In case you are interested in growth investing using fundamentals and technicals like I do, feel free to join my community using the link below. That is one edge I can help you develop. The fourth investing mistake that is keeping you poor is too much focus on money. Now, I know it sounds contradictory. After all, we are doing it all for money, right? Yes, of course, we are doing it for money. But when you're too focused on money in your Demat account, you get distracted. The daily swings lead to emotional responses that kill the compounding. The more emotional your investment account makes you, the more it will slow you down. For example, when I was a relative beginner in small cap investing, I was expecting my account to show me profits every day. There was a certain anchoring bias with numbers. I would kill a trade just because the stock was down on a day when the markets were up, only to see the stock doubling or tripling in 3 to 6 months. The other times, I'll get scared seeing lost numbers on bad days and sell half of my portfolio. Then there will be times when I will try to make too much money too fast. I still remember a Diwali day when one of the stocks I held dived 20% due to bad results. I was heavy on that trade. I put everything on one stock. Lost some 3 lakh rupees in a couple of days. It was devastating. I did everything that I possibly could just to get myself away from facing how badly I screwed up. It happens to everyone. Therefore, the best thing to do is follow your investing process without too much focus on how the money is moving every day. Make some good rules for entries, exits, position sizing, and follow them religiously. The money will be made automatically in the process. The fifth mistake is trying to look for perfection. This is especially applicable to people listening to too many investors and investment gurus asking you to research your investment well and pick your perfect stocks. There is no problem with deep research on your stocks or mutual funds or trying to research as many stocks as possible. However, if you have a full-time job, this process works against you because you will always be short on time. At some point, you will be exhausted and disinterested. The other problem with the approach is consistency bias. When you invest a certain amount of time researching a company or a stock, you want it to become investable. You will only look for positives, ignore the negatives, and stick to the bet even when the facts tell you otherwise. It doesn't happen with seasoned investors, but it happens a lot with newbies. In my investing journey, I was clear that I did not want to invest too much time researching every company I was investing in. Therefore, I spread my fishing net in locations where there was the highest probability of finding the healthiest fish. I looked for specific qualitative and quantitative traits I needed in all the companies I was investing in. I kept the bar so high that most stocks did not pass the criteria. For the ones that did, I again had simple quantitative parameters to either keep or reject the idea. For example, my first filter is usually explosive quarterly earnings growth in small cap stocks. I have set the operating profit bar so high at 70%. This is a filter that disqualifies 97% of the stock universe. I then look for breakout earnings quarter, that is, the current quarter's earnings should be the highest in the last 13 quarters. This further cuts the list by 70%. Now, after this, I look for huge technical strength in stock, which further cuts the list by 80%. So starting with 6,000 plus stocks, I'm left with 10 to 12 stocks to research. Even in research, I do basic checks, not spending more than a few minutes on one stock. Unless this cursory check highlights major red flags, I go ahead with most ideas. I think such a rules-based investing process is more suited to beginner investors than doing intense qualitative research on stock that get passed on to you by other people. The process eliminates all the biases, ensuring that you never miss a trend or a high growth stock. And the best part is that it takes much less time. Mine takes 20 hours a year while delivering life changing returns. So, those were the 5 mistakes that keep people broke in investing. If you want to know more about my investing process, watch other videos on my channel. Subscribe for more content on how to achieve financial freedom through accelerated compounding in investments. And thanks for watching.